Here's a breakdown of 3 DR basic trades from last week, setups you should all spot by now. Let's start with Thursday's regular DR session on the S&P 500 futures. Before we get into the regular DR session for Thursday on the S&P 500 futures, it's essential to step back and first analyze what's already unfolded. Looking at the aftermarket and overnight DR sessions together, we can clearly identify a DR downside model, since the overnight DR session respected the aftermarket high and never traded above it. Now fast forward to the 9:30 a.m. opening candle of the regular DR session. It's already revealing something critical. The opening price is above the overnight DR session high, which immediately invalidates the continuation of the DR downside model. That's an important early sign. Then just 15 minutes later, another key piece of information comes into play. The ADR mid gets breached. And now, if you measure the size of all 3 DR session boxes, even though the RDR hasn't fully formed yet, you'll notice that they are all expanding. This is a textbook example of a DR range expansion model beginning to take shape. Once the regular DR session is fully formed, price confirms longs with a higher probability by closing above the defining range high on a 5-minute time frame. Now we should shift our focus toward the long side of the market, but of course with solid preparation in place. This means having your volume and gap imbalances ready, and any previous DR session levels that align with the current DR session clearly marked. In this session, we find a daily gap imbalance and some stacked previous DR session levels located in the lower half of the defining range. Toward the upper part, we see the previous day's RDR lows and some volume imbalances as well. In a DR range expansion model, the target is typically the 1 standard deviation level, something I've consistently mentioned across multiple videos. Following the confirmation, we get a shallow retracement back into an area that's supported by previous DR session levels and a volume imbalance. Here's where it gets even more interesting. The tick grid indicator shows strong signs of divergence, reaching almost down to the lower extremes. This gives us an additional layer of confidence. Several high-quality confluences align here. A volume imbalance, a previous DR level, and now a tick versus price divergence. A long trade from here sets up nicely, which offers up to 5R with a target set at the 1 standard deviation level. As price pushes higher throughout the session, we see yet another confluence of the tick grid, this time rejecting the plus 0.5 standard deviation level in price while tick is reaching the lower extremes. Price reaches the 1 standard deviation level and fulfills the expectations of a well-defined range expansion model built on IDR Basics and supported by precision tools like the tick grid indicator. Let's get to number 2. Nasdaq 100 futures in Monday's overnight DR session, how to trail into the regular trading hours. Before we head into the overnight DR session for Monday, let's take a quick look at what happened in the aftermarket DR session. There was already a high-quality opportunity there where price confirmed shorts and then retraced right into the previous day's regular DR session lows. A great entry opportunity followed, which led to a clean continuation lower. Moving into the overnight DR session, it's easy to see that a DR downside model is intact. The overnight DR respected all aftermarket DR levels. On top of that, the first hour of the ODR formed a red DR box, meaning the closing price was below the opening price. Another strong piece of evidence that downside momentum could continue. Still, at this point, we didn't have a confirmation yet. If price had confirmed long, we'd need to be selective with targets due to the sensitivity of the nearby aftermarket DR session levels. In a DR downside model, those levels often act as resistance and can flip the odds against us. But if we get a short confirmation, everything aligns. The red DR box, the downside model, and the overall session structure. Roughly 1 hour later, price closes below the defining range and we get the short confirmation we were waiting for. Now the probabilities shift. There's about an 80% chance that price will stay inside or ideally below the defining range for the rest of the session, and that's something we want to leverage to our advantage. As always, we trim down the chart to highlight only the most relevant volume imbalances, specifically the open ones that haven't been rebalanced yet and therefore have magnetic potential to pull price back. Zooming out, we identify one key previous DR session level from earlier price action that aligns with this session. That gets highlighted as another layer of confluence. Price starts rejecting the ODR mid and an area stacked with multiple volume imbalances. At the same time, we have an open magnetic volume imbalance right at the recent lows. This sets up a valid short entry with stops just above the lower boundary of that previous DR session level. Unfortunately, price pulls back and stops out the position, but immediately offers something even better. The textbook retirement setup unfolds. Price rejects the IDR high, feels the magnetic imbalance, and sharply reacts off the top of the previous DR session level. We now also have two magnetic volume imbalances forming at the lows, further confirming this trade idea. When confluences align like this, it's as good as it gets. The setup from here offers up to 4R if you target the one standard deviation level, making it not only well-defined but statistically favorable. As the overnight DR session ends at 8:30 a.m., here's where an advanced layer of the strategy comes into play. What do you do if you want to hold the trade further into the regular trading hours? This is where your stop trailing decisions become crucial. If you're anticipating a continuation of the DR downside model, price should not trade back above the overnight high until the regular DR session box has fully formed. A stop above that level wouldn't make much sense, since the entry is lower than that. A smarter approach is to manage your stop relative to the ODR mid. In this example, trailing your stop just above the midline offers more precision. Price shouldn't go above this level. It would reduce the probability for the DR downside model a lot. And if it does, you'll likely be stopped out with a small gain of profits. In this case, price continues lower into the next session, continuing the downside narrative. But this kind of decision, whether to close the trade at session end or hold longer, should be part of your own backtesting process. It's how you develop deeper insights, track outcomes, and refine your strategy with confidence. And the last one for today's video, Gold Futures Friday's overnight DR session, limit order execution for refined entries. Gold Futures started the DR-IDR intraday cycle with a textbook aftermarket DR session. After confirming shorts early in the session, price retraced beautifully into the IDR mid before extending the downside move beyond 5 standard deviations. It was a clean, high-probability setup and a great trade opportunity. As we move into the overnight DR session, things continue to align. The session forms and confirms shorts just 5 minutes after the first hour, confirming that a DR downside model is in play. With confirmation now in place and the model intact, we don't want to go against the probabilities. Remember, the chance of a DR false session at this point is only around 20%. Zooming out to get better context, we notice several previous DR session levels from prior days that line up nicely with the current defining range. These become critical for potential price reactions and can serve as additional layers of confluence. As the session progresses, price pushes beyond 1 standard deviation, then begins retracing. It comes back into the defining range and reacts right off the IDR low, a cluster of volume imbalances, some previous DR session levels, and the opening price. This candle closes and offers a potential 3R trade setup while aiming for the next standard deviation level. But in this case, price retraces deeper into the range and takes out your stop on the first bullet. That's trading. No setup is bulletproof. However, price then rejects the only remaining volume imbalances within the range, as well as the prior day's regular DR session low, coming very close to the IDR mid. This time it happens so quickly that most traders probably would have missed the entry. And by the time the candle closes, the risk to reward ratio no longer makes the trade attractive. But here's where things get interesting. Just because a retracement candle didn't offer the cleanest setup doesn't mean the opportunity is gone. If your rules are still valid, you can anticipate one more move into your entry area and place a limit order with the same stop logic as before. This allows for a better entry price and a much improved risk to reward ratio while still sticking to the same rule set. In this case, that's exactly what happens. Price returns once again to the entry level and fills your order potentially 4 times, before reaching the 1.5 standard deviation level, which would have been the ideal target. It's a great example of how so-called missed opportunities aren't necessarily missed if you are patient and prepared to execute your setup on the next touch of an entry level. As always, Make sure to like the video if you want more of those breakdowns. Give me some feedback in the comments if they're helpful, and I hope to see you in the next video.
We're gonna take on the world.